How are you, folks? Enzo Di Costanzo podcast, and this is number 4. Right? Can you guys take it? Right, number 4 already. It's September. Is it September 4th? Yeah, it's September 4th, and we're up to the 4th lecture. So let's just get right to it. We're going to finish some of the asset bubble discussion from yesterday. We had some of the questions, and we didn't finish those. We'll start the ROE, the return on equity model. We'll talk about consumer confidence and sentiment. And actually, just as we're sitting here, I know you can't see this yet, University of Michigan. A couple of years ago, it was a survey of consumers. Yeah. There it is. And we'll do that. And I'm looking for the PDF of the questions. I had this. I probably have it somewhere. University of Michigan survey. The PDF. Yeah, consumer. And you'll be surprised at I probably have it in an older file somewhere. I think probably fall 2021. I probably had it somewhere. So let's see if we can just go check it real quick, folks. I apologize. I know I know you can't see it right now, but hang on. Courses, semesters. Yeah, that was survey of current business. Give me a second, folks. Give me a second. We're looking for. Actually, you know what we should do here? So you guys can see what we're doing here, what the search looks like. Full screen. Yeah, this is the survey of consumers, University of Michigan, and we want the questionnaire of this. So survey. There it is. Okay. So yeah, actually, here, let me do this. This was good. We did this. This is you. Yeah, just to run through this, it says we're interested in how people. Now, this was developed in like the 40s, and if you look at the way this is typed, obviously this was developed where you would take a piece of paper and fill it out, fill the piece of paper out. But now it's electronic, so it's not really a Google Docs form or Google form like we're used to at the school. But this is this. It looks the same from the 40s, and it says, "Are you financially, are you better or worse off than you were a year ago? Five years from now, financially better or worse off? Business conditions, what are business conditions going to look like?" And um, what are you predicting for business conditions, the country as a whole, business conditions? Is the government economic policy helping or hurting unemployment or inflation? What do you think is going to happen to interest rates? What do you think is going to happen to prices? And then there's some logic here, and it says, by what percent do you think prices are going to go up or down during the next 12 months, and those kinds of questions. But this is very good. The outlook for prices, family income, your income, the family's income. Is it a good or bad time to buy a house? Good or bad time to buy a car? Sell a house, buy a house, sell a car, buy a car. Those kinds of questions. Auto market, how's the auto market doing? Price of gasoline. Okay, so, and it didn't, and you don't have to. They're just asking for your opinion. They're not saying, "Hey, well, where did you get these numbers from?" And you could really blow it up and just make it up too, in a sense. But it's those types of questions, and you can see it's an index of consumer sentiment in our current economic conditions, and index of consumer expectations. So it's sentiment, current conditions, and then what you expect in the future. Sentiment or confidence is sort of similar. Okay, so here looking at this, sentiment better, certainly better from a year ago. Month over month, it went down a bit. It looks like the August ones went down a bit, but then year over year, everything's up dramatically, right? If you look at these, see, it says Y over Y, that means year over year change. The index of consumer sentiment up 20%, current economic conditions 30%, consumer expectations up 12%. And what happens is, based on your responses, the answers are given some kind of a weight, and then an economist or statistician develops an index and a number. As the number gets up, people have more confidence. As the number goes down, people have less confidence. Okay, so your answers are converted into an index. I'm saying into one number for everybody. I don't know how many people take the survey, but it says after rising sharply for the past several months, consumer sentiment moved sideways with a small decline that's not statistically different from July. Sentiment reached its second highest reading in 21 months, is now at about 39% above the all-time historic low reached in June 2022, when buying conditions for durables and expectations over living conditions both improved. The long-run economic outlook fell back about 12% this month, but remains higher than just 2 months ago. Consumers weighed a combination of positive and negative factors in the economy, which led to differing offsetting trends across demographic groups. Consumers perceive that the rapid improvements in the economy from the past few months have moderated, particularly with inflation, and are tentative about the outlook ahead. Year-ahead inflation expectations edged up from 3.4% last month to 3.5% this month. The reading remains 2 to 3% range, above the 2 to 3% range from the last couple of years prior to the pandemic. The long-run inflation expectation came in at about 3% for the third consecutive month, staying within the narrow 2.9 to 3.1 range for the 24th last 25 months. These expectations are elevated from the 2.2 to 2.6 range seen 2 years ago. And the universities, Michigan's been doing this for a number of decades now. And this is not a knock against myself or any of you, but a similar exercise is carried out in the Federal Reserve. But obviously, those are people with enormous statistical models and a hell of a lot of infrastructure and machinery to come up with an opinion, as opposed to just how I feel, driving to the gas station or driving to Walmart or driving to ShopRite or something like that, which is about what this is. That you don't have to be an economist, or you don't have to any of those kinds of things to participate. And I don't know if these are random, and I know it's these things are dispersed out through the country of 300 million something people, and they come up with a bunch of these answers, and this thing is looked upon very well. Okay, so this is the University of Michigan page, which is here. This is the survey, and actually I nestled this survey into our thing here, into our folder, or our filing cabinet. let's see, maybe this was just down. Oops, this was the wrong. This was here. There it is, University of Michigan. It's in the appropriate folder. Okay, so there it is. Oh, well, some of you might be seeing this court case. I was on jury duty, and this was the questionnaire for that. This has nothing to do with me. Okay, this is the state versus. This was like a shoplifter or something like that. That's all. Me saying that doesn't mean anything. That's public. Okay, that's all the court records are public. But that's why you keep, if you see, you're saying, why does that court case keep fluttering on the screen? And so it was like a June or July jury duty. I didn't get picked, and I was sort of happy to not have gotten picked for that. But yeah, so now we had the students work on this. I don't know if we're gonna do that this semester, but I've done that in semesters past. Like I said, I always try to change it. Okay, all the time, changing what we're doing here. Okay, so we stopped last time with the asset bubble discussion, and I wanted to just pick it up again here. These very few questions. It says, what happens when the market is in a bubble? You know, those kinds of things. The clear sign that the market's in a bubble when assets trade for way more than what they're truly worth. A sudden surge in prices without any clear justification or justifying factor generally suggests a bubble is underway. So I don't know. Is Tesla experiencing a bubble? We'll know in a year or two, right? You look at how many that price per earnings ratio we looked at yesterday, where the price per earnings of Tesla is so much greater than what the S&P 500 is. The S&P 500 is a 12 or 20 or 15 or something, and Tesla's got like a 60 price per earnings. So that it's way up there, and there's dramatic expectation, I guess, as to how the company's going to do. What happens when financial bubbles burst? All right, well, when these bubbles burst, the price tumbles. Those who fail to sell up before this happened can lose significant amounts of their invested capital, and companies may be forced to curtail spending, slash budgets. And when victims of bubbles are numerous, it can have a huge impact on the economy, sparking mass unemployment, reduced consumer spending, and debt deflation. Now, consumer spending, I think we all can just sort of, from just common definitions, we go to Walmart, we spend money. If you're employed or unemployed, I think we can understand that. Debt deflation means the money that you're paying back your debt with is worth more than it was maybe when you started. Okay, so it's deflation of the currency. So the currency, in a sense, where or debt deflation. The currency is it's when you have inflation, the currency is less valuable. When you have deflation, the currency is more valuable. So depending on if you're looking at it from a currency perspective or debt perspective, but you're paying back with dollars that could have bought more of something else than maybe when you started with the agreement to pay back the debt. Do bubbles affect the economy? Of course they do. Of course they do. Right? Because they promote or they because they prompt members of the population to lose lots of money, culminating monetary policy being tightened. And we'll do, and especially for the intermediate classes, we'll do some specific definitions for fiscal policy and monetary policy. Those are big pieces to the puzzle for those courses. Okay, and we're going to go over that. Widespread losses can create financial panic. They can erode spending, and they can trigger unmanageable debt. So in other words, if you're not earning, and all of a sudden, you've got mortgages to pay, or you're not working or something, that's unmanageable. That's an unmanageable situation. The bottom line here is, what is the bottom line? The stock market bubble of the 20s, the dot-com bubble of the 1990s, and the real estate bubble of the 2000s offer clear examples of how bullish investor sentiment can destroy economies and deepen inequality. Well, okay, so what do we have? We have the stock market bubble of the 20s, the dot-com bubble of the 90s, the real estate bubble of the 2000s, and these are clear examples how bullish investor sentiment can destroy economies and deepen inequality. Well, each of the bubbles has its own story. There's aspects that tie them together, including that they were driven by a flow of money being pumped into the economy via monetary expansion and lower borrowing rates. 1 second, folks. So flow of cheap money, monetary expansion, and lower borrowing rates in easier terms. Eventually, policies are reversed, money dries up, people realize the assets are trading way beyond what they're truly worth. And when this happens, the results can be catastrophic, not just for the participants, but for everybody in the economy. Yeah, this was an important enough topic where I don't mind that we sort of, we had this, two YouTube lectures kind of had this. Now, Yeah, we're going to talk about confidence and sentiment is going to be next. So we finished the question. I have a little all right, finish the questions we did. Okay, that we did. I want to go over return on equity. And again, this is not an accounting class, but people who are people who are economists, and if you're going to be a private banker or investment banker or an analyst or something, or an economist, that's, you know, being able to work these ratios is extremely important. Okay, this is extremely important. So here, so what we'll do is, how much of this are we going to talk about today? We'll do a little bit of return on equity, but the first, what I'd rather do, because we just spoke about the sentiment and confidence part just now, I just want to just quickly go over finding the confidence versus sentiment. There it is. And again, you guys have this. This is in the document. These are my notes that are posted on Blackboard. It says 2 of the most important numbers that investors listen for every month are based on surveys that aim at understanding and tracking the behavior and the mood of the American consumer. 2/3 of the American economy consists of consumer spending, and it's understandable the mood is a constant source of anxiety among American investors. Okay, the consumer confidence, and now the Michigan Consumer Sentiment Index. This is the one that we just looked at. Okay, consumer sentiment. Okay, it says consumer sentiment right there. And setting, I think the Michigan, they called it the sentiment index instead of the consumer sentiment index. You know, the whole thing, the consumer. This other one, I haven't looked at the consumer confidence index, but this is another one. And the Michigan one was easy to find everything. This one wanted a password or something, if I remember correctly. But I think they're very similar. They're both published monthly. They suggest the mood of consumers and their attitude towards spending is getting better or worse. Confidence and sentiment are shorthand for 2 monthly surveys of different sources. Each aims at judging the degree of confidence that Americans feel about their current financial status and their expectations have changed for better or worse in the near future. In other words, do they feel free to spend? The Consumer Confidence Index is published by the Conference Board, a not-for-profit research organization for businesses. The survey is a sample of 3,000 households from across 9 census regions. Okay, so that they're telling you the Conference Board one, it's 3,000 households. And this is whenever these notes were generated a couple of years ago. The survey covers current business conditions for the next 6 months, employment conditions the next 6 months, and so income, employment, and business conditions are sort of the overarching. How easy to get a loan, how easy it is to start a business, are there regulatory problems with opening businesses and things of that nature. Consumer Sentiment, MCSI, is a national survey. Okay, this is only 500 houses. Well, there we go. Now we have the number. So yeah, so the Conference Board is about 6 times bigger than this. This is only 500. The other one's 3,000. So that's 6 times. Conducted by the University of Michigan, and the purpose is to collect information about consumer expectations regarding the overall economy. The consumer confidence numbers published in the Tuesday of every month, and the Michigan survey also covers. Yeah, this is what we just went through: business conditions for a year or 5 years. Now, business conditions are just sort of the overall sense of what's going on: interest rates, how the stock market is doing, those kinds of things. How easy it is, the loan qualifications, how the real estate sector is doing, personal finance expectations, economic expectations, buying conditions, personal finances, current economic indices. Investors look at the results of both of these surveys the same way. If the number is up from last month, it's consumers willing to spend more money. If the number is down, they're spending less money or tightening their belts. The results can and do diverge in the short term due to a number of factors. Both surveys are conducted monthly, but not simultaneously, and a sudden change in gas prices or a drop in the stock market can affect the numbers. The Conference Board surveys query a large sample, while the Michigan survey has more detailed questions. And some people have, is this better for employment? Is the Michigan survey better for consumer issues and things of that nature? Okay. We looked at asset bubbles already. All right, so we did a little bit of this. We did the consumer sentiment and that survey. That was short. Okay, that wasn't too long. And now we'll spend a little bit of time on return on equity, and then we'll hit the Excel in a little bit. And actually, even before we sort of discuss this, what we needed to do, we needed to expand, because I wanted to do return on invested capital. We would need, for assets, we would need the cash positions and things of that nature. So what we're going to do is we're going to click right there. And you don't have all of this yet, but it's coming. So I want the cash numbers here. Okay. We want cash right here. This is right. Okay. Those are the cash numbers. So let's look at, and we could break this up a bit. We want the three, because we don't need this today, but since we're just, today's sort of we're piecing things together today, kind of a day. Not just cash, but also short-term investments. That's also cash. Control D and Control R. Like I said, get comfortable and get used to Excel and what you can do with it. So, okay. So the cash numbers are 16, 253, 123, 17, 576, 3. Short-term investments are next. And remember, we had to add the 3 zeros into this. Okay, I think we did that during last night's session. We're keeping this up for thousands. We're going to keep this as thousands. Receivables, and so this is just sort of the current asset numbers. Now, we want the next year. We want whatever year this is, 2020, I suppose, or 2019. No, 2020. So I want the cash numbers for 2020. I mean, we'll see for 2019 also. So what we'll do is we'll go back to Tesla annual report. Okay, so here are the cash numbers here. So this was 17, this was 19, 3, 8, 4, 1, 2, 3. This was 0. Okay. And maybe we could take some averages of these also. But this is for return on invested capital, where I think what I saw, and we can sort of just work with it a little bit today. Also, these were subtracted out. Yeah, so obviously you're going to get a little bit of a higher number. But we're going to work on this. We're going to work on this. So this is not. See, we probably yeah. So and also what we'll do for you guys here is we'll do. Let's get to our version of this here. Okay, so we did put all this stuff in here. Yeah. So from effective rate, let's just sort of slide over here. Because we added a little bit more to it. So let's go back to our file here. Go to effective rate, paste, and we'll get rid of all these computations. And we know that we have to work on this. But that's for something else. Okay, that's for something else. Okay, let's talk about because you're going to need the equity pieces for this, and we're going to get to that. So let's talk a little, and we're not going to finish return on equity today. So this might be a little bit of a shorter lecture today, but we're going to get the equity entries from the balance sheet. And like I said, if this was an accounting class, we'd full bore model everything, but we're not going to do that because it's not an accounting class. Okay. Well, let's talk a little about return on equity. And like I said, so we spoke with economics today a bit. Let's talk about this a little bit. What this tells you. Okay. So what you need to know about this measure of financial performance. Measures financial performance calculated by dividing net income by shareholders' equity. Because shareholders' equity is equal to a company's asset minus its debt, ROE is considered a return on net assets. So this is assets minus debt as opposed to return on assets, which is just the remember the accounting equation, assets equals liability plus equity. So it's considered a gauge for corporate profitability, how efficient it is in generating its profits. The higher the ROE, the more efficient the company's management is generating income and growth from equity funds. So in other words, with a healthcare deal, someone invests to build a hospital, build research laboratories, a place for pharmaceutical trials. How about that? And then, how productive was all of that investment in terms of, what you earned from it. Equity is the measure of ROE is the measure of net dividends divided by shareholders' equity. Now, we're doing this in a very general sense. Like I said, this was an accounting class. We talk about preferred dividends and this. We talk about a lot of other things. Okay, but we're just in a very blunt way. We'll go through this, and if and when you take this in other classes, you'll get their perspective on it. And folks, let me just mention something. Because you may have heard of Tesla in another class or heard of some of these analytical techniques, doesn't mean that you're an expert at it. Okay, it's sort of an outrageous. Someone said it to me. It's sort of an outrageous thing to say, "Oh, well, I had another class and we went over this," or, "Well, I mean, but you're getting my perspective on this." And do you think you're going to hear things just once, and you're going to hear it once in a class somewhere and be done with it? I doubt that. Okay, you'll. And especially in legal practices and things of that nature, you want repetition on certain types of cases and certain types of arguments and certain types of legal situations and legal rationale. If that's a conflict in terms, saying that there's a legal rationale for what we're doing here, right? That might be an oxymoron or conflicting terms in a sense, but you want repetition and you want to hear different people's perspectives on the same kind of thing. And these are important. If you're hearing it in a couple different classes, obviously it's an important topic. So, right. So it's a gauge of a corporation's profitability and how efficiently generates the profits. The higher the ROE, the better the company is converting its equity financing into profits. To calculate the ROE, divide net income by the value of the shareholders' equity, and ROEs will vary based on industry sector and in which the company operates. Now, you could just do it sort of at a point in time and say, okay, I'm going to take the net income divided by the equity at the end of the year, or you can take an average equity, this year's equity and last year's equity, divide those by 2. That could be the denominator. Okay, so there's a couple different ways you can approach this. ROE is expressed as a percentage and can be calculated for any company if net income and equity are both positive numbers. Yeah, that's another thing where if you look at Tesla, so we have a couple years of operating income here for Tesla, right? We have a few, we did 3 years or whatever. But as you go back 19, 18, they're losing money, and the equity numbers may not be so conducive to these ratios. Generally work for growing to mature companies. If you're like a startup, or if you're hostess, you're winding down your operations or something like that, these ratios may not help you as much. Certainly, if there's a negative net income, what does it really mean? You're just losing money and that's it. Okay, so that you have to look at the situation that you're in. It's not like algebra where you just paint it with a wide brush and you go over these 15 things and that's it. There's a lot more art to this than I mean, there's a scientific angle, but there's also an artistic, creative angle to it also. Okay. Yeah. So we're going to go back and discuss how to do some of these. So there's the equation. ROE is net income by average shareholders' equity, and then also it's net income before dividends are paid to common shareholders, but after the preferred shareholders get them. Now, if a company doesn't have preferred dividends, then that's just zero, and interest to lenders, right, and that kind of a thing. After dividends to preferred and interest to lenders. Okay. Yeah, that interest to lenders thing. I mean, I guess you, yeah, but again, as long as you know what your numerator is and what your denominator is, again, this is a very general looking formula here. But as long as you understand what you're doing and why you're doing what you're doing, you can get a return based on the money that came in, and then, but after you pay out interest, yeah. So obviously, yeah. So and after dividends to preferred are paid, and yeah, so right, that's your interest expense. So of course, your net income would include that, of course. So net income, net of expenses and taxes that a company generates for a given period. Average share is calculated by adding equity at the beginning of the period. The beginning and the and end of the period should coincide with the period during which the net income is earned, and you take the average of those. Okay. So it's net income after the last trailing 12 months. It's found on the income statement and some of the financial activity of the period. Shareholders' equity comes from the balance sheet. Okay, so where these come from. All right, so this net income is from the income statement. So again, this is, and again, if you're a bank examiner, what do you think you're looking at? Okay, you're going to, if you're working for the Federal Reserve, if you're a bank examiner, you're looking at financial statements, and you got to be able to interpret a balance sheet, an income statement, a cash flow statement, as well as an accountant would interpret it. So it's considered best practices to compute ROE based on average equity over a period, because the mismatch between the income statement and the balance sheet. So in other words, the income statement is what happened in the last 12 months. The balance sheet is a point in time. Calculating return on equity, it's calculated by comparing the proportion of net income against the amount of shareholders' equity. Okay, we see the equation again. Net income is the difference between revenue and all expenses, including interest and taxes, and it's the most conservative measure of a company to analyze, as it deducts more expenses than any other profitability measure, such as gross income or operating income. Because net income is earned over a period of time, shareholders' equity is a balance sheet account, often reporting on a single specific period. An analyst should take an average equity balance. This is often done by taking the average between the beginning balance and the ending balance. So yeah, okay, and there's a sustainable growth period to this, and there's a couple of uh, there's a few sort of situations, inconsistent profits or excess debt or negative net income, and it's sort of uh, where you struggle to use it a bit. Return on invested capital is its own discussion. And actually, what I'm probably going to do is I'm probably going to get the notes for that and drop them off in here. And actually, and also and we'll pick this up in the next video. The At one time I looked at Amazon, Apple, Alphabet, and we made our ROE computation. We're just going to stick with Tesla. If this was an accounting class, we'd worry about, we would worry about doing this like this. And actually, these are just some of the different years. Not different years. No, this is a split fiscal 2022 or whatever it is. Yeah. And also we have the DuPont analysis, and we'll sort of get you guys ready for that. The American Chemical. So the DuPont had a version of this also that we'll sort of get to. And actually, while we're here, you know what? Let's just quickly do this. Because I just copied it from, I have a bigger sort of reservoir of notes here. This is some of the monetary policy and the fiscal policy stuff. We'll discuss that in there's an intermediate class where I want to cover some of those topics also. So we'll give everybody the benefit of some good knowledge, right? Which is always the point here, to give you the best time that we're going to spend possible, the most useful knowledge that we could impart on you guys. Yes, and again, it's probably a good thing for you guys to learn how to copy and paste a lot of this stuff yourselves. Yield. We'll look at leverage ratios, equity multiple. We'll have some discussions about that. And folks, that stuff applies. It's across the board. You see that in economics. You can see that stuff in finance. Okay, you see that in a lot of different areas. Okay, so we mentioned that, and then it talks about what return on equity tells you. Let's see, where's a good starting or ending point for this? Actually, there would have been a good, because that, like I said, I can pick this up tomorrow, and we could sort of roll through the rest of this, and with the DuPont stuff and things of that nature. Okay, like I said, but let's set ourselves up for the because there's a sustainable growth thing, and we want to discuss that also. So let's do this. We'll pick this up. Now the fifth video probably won't be till the end of the week. But what I want to do is let's save this to PDF with this thing. And actually, what I need to do is I need to go back into Blackboard. I need to update because I've made so many changes to this. When it was up, it wasn't 113 pages when I posted this up there. Okay, let's at least do some of our Excel stuff. And like I said, this might be a little bit of a shorter video. Okay, so we're here. So now again, and also probably what I should do, the master file may not have all this, so I'm going to update the master file pretty soon also. Yeah, because I think the master file only has this much. Okay, so actually what we'll do, we can open, and again, this is seeing how I sort of plan all this out. This is all a part of what we do here. Yeah, here it is. Yeah, this is just up to EBITDA, and that's it. So here's effective rate. Yeah, and then we have some very nice Warren Buffett material that I want to go over too. So we'll do that. But here, let's hit a little bit of this just to make just we're gonna do a little bit of computation with this to get effective tax rates and things of that nature. Now you pay a certain amount of tax, right? You're gonna pay a certain amount of tax. Here's your provision for taxes. Okay, and then you had profits before, and it's not relative to net income, it's relative to what's paid here. Okay, so you can take your provisions and divide it by profit or loss before income taxes. Equals provision for taxes divided by profit. So you see where it says equals H, so it's column H, row 43, divided by column H, row 41, hit return. And this is formatted as a percentage. So your Excel, you have to have some Excel stuff. Okay, you got to have some Excel stuff there. Okay, or Excel formatting and knowing how many decimal places and percentages, it's centered. Looking under the alignment, see it's going to be centered. So there's all those details. And now instead of going through all these cells and retyping that equation, as long as you have the cell where the formula is selected, and also there's no dollar signs or anchoring, so you're not saying, well, only this row or only this column. You can say Shift right arrow and then say Control R, and it computes it all the way across. So the effective rate was 25%, the effective rate was 11%, the effective rate was 8.25%. Okay, that's how you do this stuff. Okay, see the two little dots, right? Provision for taxes divided by the 13 billion, so it's a billion divided by 13 billion. Okay, see, you need that for the DuPont formula. That's the effective tax rate. For cash, what you can do, or what you should do, is go to, let's close this down. Yeah, there's cash here and short-term investments, and I think assets, right? So under assets, we're looking at total assets for this year and 2022. Fiscal 2022. All right. Your asset number is 82,338,000,000, and then put three more zeros, right? Which we didn't do the other time. That's 62,131,123. 1, 2, 3. And you're just entering your cash numbers, which again you're going to need for return on invested capital. Your cash and short-term investments are, this is 5,932,123, 16,253,123, 17,576,123, and then 131,123, 131 million. Okay, and we'll need those. We'll need, but obviously the cash position has increased a bit. Liabilities, again, this is for the return on invested capital. Liabilities are 36,440,123,358,23. Okay. There's, and now you have some other components of this that are going to be, they're going to be important. You've got current portion, billion, and then debt and finance leases are the non-current part. Okay. And again, we'll need those. And again, if this is accounting glitch, we'd make the whole thing. Okay, but we're just going to take some bits and pieces, and then we're going to move on to fiscal policy. We're going to monetary policy, and we'll move on to some of the intermediate macro material, also some of the Warren Buffett stuff, and we'll give you a nice piece of all good things in here. All right, 30 billion, 44 billion. Well, there you go. Now, also, you have 2022 and 2021. Let's get 2020. So that one, for whatever reason, there's no PDF of 2020. There's just an HTML file. So let's go to our HTML, which is right there. Okay. And we can just, in by bits and pieces here. Here's the cash number. So 19,384,1. So 19 billion in cash, 0 and short-term pieces there. And 2148. The liabilities part of this 30, 28, 418, 123. And then the current portion here is going to be what? 1589, 2132. That's 2 billion, and debt net of all this. There you go. And the equity part is here. $22,225,123. All right, 22 billion. Okay. All right. We did some entries of these numbers, and return on assets is pretty basic. Return on assets is just simply equal net income, not EBITDA, but net income divided by your asset number, which is right there. Now, there's another version of this. We're going to do the other ones at another time. But so this was just simply net income over assets. We can also do equals net income divided by the average of the array of the last two readings of assets. That's these two, right? That's these two. 17. So you can see a little bit different. And now you're sitting there saying, "Oh, well, professor, where's the answer in the back of the book?" And well, I'm teaching you folks. We're teaching you real stuff. Okay, we're teaching you how to do real things in here. That's the average of the last two assets. So it's net income over the average of the last two asset readings. Now, also a byproduct of all this is learning a lot of Excel maneuvers, which generally over the years people have generally been happy to learn. I don't know if something's dramatically changed recently, but as long as I've been on days, people have been happy to learn this stuff. You want to check those. Well, how do you call the company? Well, no. Here, what are we going to do? We're going to go to, oops, it's not cooperating with me for some reason. Yahoo Finance. We'll do that. We'll go Yahoo Finance, Tesla, TSLA. And there's a statistics tab here somewhere. You could worry about the market capitalization, but see the price per earnings is 73. Wow, that's a lot. Okay, that's there's a lot of optimism, I suppose, for this company. So let's look at the statistics end of this. And yeah, and we're going to find return on assets. There it is. The last, whoops, it moved on us. The last 12 months of this, about 9% or so. Okay. And what do we, oh, so here we were 15, here we were this. So what may have happened is that one of the quarters, the first quarter or something, because we're all the way to September. This is fiscal 2022. We've already had 2 quarters, almost 3, right? So around November, January, March, April, May, June, July, August. So yeah, we're in the 3rd quarter now, and they're probably, so maybe the first 2 quarters in terms of income, Tesla didn't do that, and we can track that down. No, the market capitalization's increased. It's increased a lot, but it was 800 in September 2022, and then the first quarter it was down to 650, and then 830 again, and now it's 777. So the market capitalization is declined a bit. Price to earnings also has declined. It was at 95 and 59. Now we're down to 54, 53. We're down to 69 from 95 and from 91. So most likely, and price per sales, if that's declining, that means sales could be increasing or price could be decreasing, whichever one is stronger. So most likely their earnings suffered a bit. So I don't know if they have some of the quarterly numbers here. Here's financials. Income statement. Okay, well, the trailing 12 months seem to be the 2022 numbers here, at least for the annual numbers, right? Let's do quarterly. All right, revenues are here. Okay. Pre-tax is up there still. Yeah, see the net income numbers are down. You were 3 billion, 3 billion. Now you're 2.5, and um, and what's our profit number looking like? 12. All right, we were at 12. So yeah, the trend, that's a trend. So you gotta multiply these by 4. But see, they're down from where they were here. Here you're at 3 billion, 3 billion, 3.7, 3.3. This is 2.5, 2.7. So yeah, your earnings. So we had predicted that, right? Obviously, we predicted that. Okay, that's return on asset. Now the equity number would be, again, the point version would be net profit divided by your equity number. 44 billion. 28. The averages version of this would be EBIT, net income divided by average of the last two equity readings at 33. And again, so let's check online. And what are the equity numbers looking like? Yep, 27% for equity. Yeah, there's 28, 33. So there you go. Okay, so we're a little closer with these. And what was the ROA? 10 here, a little 15, 17. So a little further. But again, it's where we're looking at this also. We were looking at it where they're a little higher net incomes. So it makes sense that these numbers are where they are. Okay, we did that one. Return on invested capital was, I don't know. I'll throw this on up to the wall. It's that net income divided by parenthesis. The equity number plus the debt numbers. And then you subtract, you're supposed to subtract out the cash. Yeah, that's 49%. Well, we have to check that. I don't know if this exists here. Do we have return on invested capital assets? I'm surprised that it wouldn't be here. EBITDA was 16. Let's look at our EBITDA computation. Yeah, 17, 16. Okay. Most recent quarter, MRQ's most recent quarter. Book per share, we always want to know that. Yeah, they don't have return on invested capital. That's odd. That's an important measure, and they kind of left it out on us here. But okay. Profit margin is about 12. Operating margin is about 13%. Yeah, 16. We have 16 out of that. So the profit you can just start dividing these the net profit by revenue, operating profit loss by revenue stuff. You can start doing things like that. Okay. So we did that one, but again, this one we're not sure about yet. And then now what you're going to do to the last version of this. This is the DuPont version where you have all these other ratios. Earnings before taxes are right there. There's earning before taxes divided by sales, or the total revenue number, which is up here. We have that ratio. So that's at 16% earning. That's almost like a profit margin. Sales to assets, which are there. And now sales, again, how based on the assets that you have, how much sales are you generating? This asset equity one, this is sort of almost like a percentage of how much of your capital structure is equity, how much of your capital structure is debt. It's like that. And what you're supposed to do with this is you're supposed to create, a product array, and you're praying that you get the same number. That's I the other day I had a little bit closer than this. So it's actually exact last time, so I don't know what happened here. 98, 16. There we go. Exact. 28, 16, 20. See, it's exact with this. I had the wrong sales figure. Okay. But again, we're going to discuss this in the next lecture. Okay. We'll discuss this in the next lecture. All right. So this was a little quicker lecture today, just to get you talking about return on equity and things of that nature. So we have a couple weeks. We have, I guess, 2 weeks of lectures sort of in the can, as we like to say. Right. So you're getting some sense of, this very good sense of using these spreadsheets to, analyze companies. And we're going to look at the macroeconomy too, fiscal policy, monetary policy. And again, maybe we might look at the Federal Open Market Committee notes and things of that nature. Might spend some time doing that. Okay. There's some stuff in the textbook you might want to look at. But we're going to cover in all the courses. We're going to cover everything you need to cover for all the courses. There was a little bit of panic at the beginning. I don't know why, but there was a little bit of panic at the beginning of this semester for that. I don't know what the reason for that was. But next time we're together. So for the 5th lecture, what are we going to do for the 5th lecture? 5th lecture, we're going to do more ROE notes and more ROE Excel model. All right, that'll be the next lecture that and then we'll start doing fiscal policy margin. We'll start hitting some of the sort of the textbook areas. But I wanted to have, and maybe the more Warren Buffett stuff, right? The dividend yield, Warren Buffett. We can start looking at the model for his work. We did some dividends. We did some graphs. And then for the 6th lecture, we could do second Buffett article, and then American Express. This would be Coke. We'd make the Warren Buffett Coca-Cola, because you already saw the return on equity model. But we'll do it again. So we have the next couple lectures already sort of mapped out for us. Okay. And like I said, the University of Michigan survey, that's a nice survey to read through, and even you could take it yourself. There's nothing stopping you from having being able to take that yourselves. That's all well and good. I'm just going to PDF this while we're sitting here, and what I'll do is I'll probably post some new freshen up the Excel also, maybe later in the week. All right, folks. Thank you very much. We'll see you soon.